Joe Stiglitz, your basic message is, would everyone calm down? Why is this inflation not like the inflation of Heller's 70s?
Well, first of all, it's mostly a supply side inflation. And think about some of the things that are really driving it. Take the price of energy, the price of oil. It's way up. We have a war in Ukraine. We understand that. But we know over the long run, and when I'm talking about the long run, it's not that long, the price of oil, energy, is going to come down because the backstop, as we call it, we know we can produce an unlimited amount of renewable energy at the equivalent of about $30, $40, $50 a barrel. And that number keeps coming down. So that is the number that energy is going to be at. So we're going to be disinflation. We're going to go through disinflation in the future. Well, I can't tell you when it's going to happen.
Right. Oh, fair. Okay. You know, what's so important here, Joe, and if people even redux back to 1947 out to the Eisenhower disinflation and the two bouts of disinflation we had into the early 1950s. Once inflation begins to disinflate, do you believe it keeps going, or do we come down and stay at a certain point, which causes an uproar? Is there a momentum to a disinflation?
Well, people used to think that there was a momentum on inflation and then a momentum on disinflation. But the forces for that momentum are much, much weaker today than they were, say, 50 years ago. 50 years ago, unions were strong. When prices went up, they demanded higher wages. The higher wages led to higher prices. Unions are weak. And so we're back to, you might call, normal competitive forces. And what we saw in the years before the pandemic, that overall supply was extraordinarily robust and prices were kept down. And I think we're going to be returning to that kind of a world.
Well, what's the Fed's role in this then? Because there is this belief out there that this is a different moment, and people point to not just oil prices and commodity prices, but also this fissure between the U.S. and China and a reshoring of some of the supplies, which is naturally inflationary. Also, some of the conflicts inflationary by nature with Russia and Ukraine. How much are you looking at a Fed that, even if they don't want to, has to raise rates substantially to get ahead of inflation that may disinflate down the line, but not quickly enough to create some real threats to this economy?
Well, first of all, almost all those forces you cite are either long-term or relatively small. Yeah, we're going to be reshoring. We have low-cost suppliers that are alternative to China. Vietnam and Asia, Latin America has a lot of capacity. So yes, costs are going to go up, and there's going to be a readjustment. But it's going to take over a number of years, and it's not going to be that big. We ought to get prepared for it. What I worry is on the other side, that the Fed works too fast and too much. And remember, it takes about 18 months for the full effects of monetary policy to be felt. And in that span of 18 months, if the war in Russia comes to an end, the energy prices will come down, and that will be a strong disinflationary force. Food prices will come down. There are already signs of that. And that will be a strong disinflationary force. You remember, over the last 50 years, public policy has been telling farmers, don't produce.
Yeah.
Don't make so much food. And if we just reverse that policy, prices of agricultural goods are going to come down.
Yeah.
So again, we have a backstop here that it's hard for me to believe that we'll sit by and simply let prices be so high while we continue to subsidize our farmers. We're going to tell our farmers.
Joe, it seems like you think that the potential error is worse by the Fed going too fast rather than too slowly, which is the opposite of what a lot of people are saying, including some Fed members. What would you have to see to change your mind in terms of the data, in terms of the incoming developments on the ground in the economy?
Well, I would be looking for a particular acceleration of inflation. Right now, wages are not keeping up with prices. Uh, Really, the opposite of what you would expect in a very tight labor market. So if I saw real wages going up dramatically and I saw inflation start to take off at a higher rate, rather now the rate of inflation is dampening. It's still going up, but it's at much lower rate. Those are signs that I would
Right.
would lead me to take stronger action.